Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Hey, this is Lance, host of Real Estate Risk Report. Thanks for joining us today. I have Bill Fairman with Carolina Capital, based in South Carolina with us today. How you doing, Bill?
Doing great, Lance. Thanks so much for having me on.
Yeah, no, pleasure's all mine. It's a little backstory with Bill. I've known Bill and his business partner, Wendy, for, probably 6 years now, 7 years.
It's closer to 6, but getting close to 7 as well.
Yeah, exactly. So it's been quite a while, and we've followed their story kind of from the early days of them launching their own investment fund and those sorts of things. And so they've been a client of ours since that time, and I've got a chance to get to know them pretty well. So what they do is they're private lenders. And they've, like I said, they got an investment fund. So why don't you just share a little bit about us, like kind of specifically, the sorts of deals that you guys do and the types of borrowers you work with, and, those sorts of projects, and how you guys, kind of solve your client's problem, which is the borrower.
Sure. So first of all, I want to thank you for helping us move to that next level. If it wasn't for our meeting at the AAPL event, we wouldn't have moved to that level in the time that we did, and we're forever grateful, by the way.
Yeah.
So like you said, we are private lenders. Both Wendy and I have 30 plus years each in mortgage finance. Mortgage finance, for those who don't know, is a lot like being a insurance adjuster, where you're constantly evaluating risk based on, many factors. What we do we're based in the Charlotte, North Carolina market. Our business is in South Carolina, but it's a little bedroom community of Charlotte. Mm-hmm. It's a good growth area. We are focused mainly on single family homes that are in the affordable market. And, every market's a little bit different. Our market tends to be $350,000 or less for affordable housing. We chose that particular focus because of a couple of factors. As a banker, you're always looking at, if I have to take this property back tomorrow, how quickly can I get it sold and get that money working again? Mm-hmm. Because it's not about, taking the house back and then, having a nice margin in there. You also have to think about the time that money's not investing and not working for you. Mm-hmm. So it's always speed. How quickly can we sell it? And the affordable housing is the most liquid out of the single family real estate. You've got first-time home buyers, you've got real estate investors, and you have empty nesters all interested in affordable housing. And then worst case scenario, if you're in a climate where you can't sell the house, at least you can rent it out for close to what your expected returns are. Mm-hmm. So that's why we focus on mainly the single family affordable housing, and then recession resistant commercial properties like small multifamily and some self-storage stuff.
Right. Yeah, exactly. So for you guys and the borrowers that are coming to you, what are they generally, what are they trying to accomplish? So they're in a position where they're buying and repositioning the house, sort of looking to fix and flip it, or what is that kind of profile of the borrower and what they're trying to accomplish?
Our average borrower has fixed and flipped probably 6 to 8 properties already. Their main goal is to buy a property at a discount because it's distressed, mm-hmm. Fix it up and sell it to a owner occupant. Mm-hmm. Secondarily, some of our borrowers are doing the same thing, but they're fixing them up in order to rent them out. And then they're going to refinance out of our loan as soon as that house is rentable, so to speak. On the multifamily and self-storage, it's basically the same thing. They're buying these at a discount. There is some construction component involved. They're repositioning them, getting them what's called stabilized. So they're producing income and then they're refinancing them. The vast majority of the single family, though, is folks that are wanting to sell these for a profit.
Yeah.
But what we find is that our borrowers who have, flipped 6-8 properties are finally learning that building wealth over time, you need to own properties as well. So instead of just keeping that eye on just fixing, flipping, and going to the next one, they'll take one or two out, a year and hold on to them for themselves for wealth building down the road.
So for you as sort of, underwriting a particular, borrower project, I mean, clearly you're saying, hey, I'd like to see someone who's, done a few, obviously has some experience, I guess we'll call that, their track record. What are the other big areas that you're looking at when you're underwriting, a potential deal? I mean, I know a lot of this stuff would be sort of underwritten to the after repair value, right? Of them
Sure.
saying, hey, I bought it for X, I think once I do Y to it, it'll end up being worth, Z, which would be the ARV.
Sure.
So for you, I mean, what does that look like in terms of the back and forth? I mean, I'm assuming they always think it's one thing. And of course you're looking at it going, nice try. I don't quite think that that's how it's going to go, or maybe give us a little bit of color, into how that exchange goes between you and the borrower as
Sure.
for that financing.
Well, Wendy has probably been involved in over 500 rehabs herself. She's a licensed realtor in 2 states, and she's, has MLS ability. So she can look up closed comps on most any property that comes in front of us. Mm-hmm. So we do the so-called BS test. We take what they say it's worth, and then we kind of get an overview ourselves. One of the reasons we try to stay regional in our lending is because we know our markets and we have feet on the ground, and we understand where the markets are going in those areas. So no matter what we do, we're still going to order a subject to completion appraisal, and we're also getting an as-is value on those. So it's going to be within that range before we do anything with them anyway. And yeah, you're going to get a little bit of pushback. And unfortunately, we're asking appraisers to give a future value on data that is looking backwards.
Mm-hmm. Yeah.
So at that point, again, you're still looking at your market and trying to understand where it's going. At the same time, you want to lend to people of good character. So, not only do we pull credit on these folks, but we also do criminal background checks on all of them. We have to make sure that they have reserves in the bank, because we know as real estate investors ourselves that nothing ever goes according to plan. Mm-hmm. And they have to have the wherewithal to overcome obstacles along the way. And then lastly, is the property in an area where we know we can move it quickly if we have to take it back. Just like I said earlier, it's got to be one of those where we want to be able to liquidate it as quickly as possible. And the last thing we want is somebody's property. As a banker, you're looking for the interest and loan fees. You don't want the properties back. So we go to great efforts to make sure that we're only doing deals that are going to benefit the borrower, the investors.
Mm-hmm. So for you, I mean, what is your greatest concern? Like if you had to, choose sort of the number one risk, I mean, after you send that money out, wire the money out, what is the thing that keeps you up at night, or, that you're most concerned that could go south, to put you in a position where you might have to foreclose and take the property back?
Well, my biggest concern, and there's not really a whole lot I can do about this, is if our borrower ends up getting loans from 5 different people on 5 different projects, and we've only underwritten the one.
Mm-hmm.
And there's not really a lot you can do about that. You can do a part of that background check. You can do some property checks, but once we've already made the loan, we can't control if they go out and get other loans on other properties and, do more. The biggest problem that you would have is somebody getting out over their skis, trying to do too much and not have enough crews to do it. And now, that said, the money on our particular properties are going out based on draws and how far along they are, because it's inspected before we, give them any money to pay off any construction that they've done so far. And everything has to be completed before we pay it. Mm-hmm. And the reason I'm concerned about that is because I'm making sure that they have a certain amount of liquid assets in their bank.
Yeah.
Like I said, because they're going to have to overcome obstacles. But if they're using that same liquid assets for 3 other loans they've got going, then obviously they're going to be short if something comes up.
Mm-hmm. So in all your time doing this, since you guys have been in here, you have any good stories about sort of the stripes you've earned along the way? The investment you wish you could, the deal you could have taken back. Yeah.
Yes. Well, we had at the end of 2017, we had just such a case where we had a major builder in our area. We had 26 properties we had to take back from that person at one time. Now, it's one thing to have it spread out over time, but when you do it at once, it creates a lot of havoc. Now, that particular borrower didn't have 26 loans with us, but he was also the major contractor on other borrowers that we had. And when he got over his skis and went under, all the other borrowers that he was the contractor on quit and just gave them back too. So
interesting.
It was a tough period of time, but that's one of the benefits of being in a fund where your money is pooled over many, many loans, that you can still take a hit like that and still overcome it.
Right. Yeah.
And
the power of the diversification.
Yep, yeah. Absolutely. And, we've been in this business a long time, and we have a lot of people that prefer to do the loans themselves or buy notes from us instead of participating in the fund. Some of them can't qualify, obviously, because they're not accredited investors. Right. And those are the people that really run the risk, where they put a big chunk of change in the one asset. Mm-hmm. And if the loan does go south, it doesn't mean you're going to lose money, but you're certainly not making any until you figure out the disposition of the property. And that's why I love the security and the benefit of numbers and being able to overcome a hit, like that.
Yeah. Yeah. So in the case, the guy who got over his skis, so what his story was, he was sort of, he had his own portfolio of assets, but was primarily, he's a construction guy. He's a general contractor.
Yeah.
And so what happened to him, obviously he took on more than, bit off more than he could chew, but was there other things sort of, what else was behind there? What else was going on that led to it? Was it just, it was a lack of,
well, there was a big boom in the luxury market in Charlotte at the time, and some areas of town that were becoming really popular. And it was a lot of people grabbing up fairly inexpensive properties, but across the street from them, they were selling for nearly $1 million, and so values went up a little too quickly for. I didn't like how fast they were going up.
Yeah. Yep.
I'm not a big fan of the luxury market anyway, because it's kind of a boom and bust situation. Again, I've been in it 30 years. I've seen it happen. As soon as you have a little downturn in the economy a little bit, the luxury market is the first thing that kind of seizes up a little bit.
Mm-hmm.
And in this particular case, he had purchased a bunch of properties and wasn't able to start construction on them right away because we had a big shortage of labor in the area at that time too. we had commercial construction going on in downtown Charlotte, and every day a foreman would come over to somebody else's site and tell everybody they'd pay them $2 more an hour if they come over to them. And it was hurting everyone. The cities were having issues too. They didn't have enough inspectors and folks in place at the municipalities to keep up with the boom that was going on as well. So when you get put behind like that, you can't pay your subs because you can't get signed off on inspections and get your next draw. And that's what happens when you go too fast, too quick. Mm-hmm. And again, we weren't the only ones that he was doing business with. So it's hard to control that.
Yeah, no, exactly. I mean, that's just it, right? Like you've got these market dynamics that, that's one of the, I mean, like you said, it's like knowing the area that you're doing deals in, but I think it's a great example of, you've got these macro sort of things going on, and in this case, in the Charlotte, metropolitan, the MSA or whatever. And right. I mean, like you said, the fact that it is all interconnected in some way, shape or form, and, values are going up. And I mean, and I'm assuming too, there's a tinge of sort of greed in here. Like it's a cash grab. Like that guy's thinking, you got to take it while the getting's good here. And, and and then it ends up just sort of spiraling, right? And everything, that interconnectedness now, and that locality, and the fact that you guys know your backyard sort of ends up, works against you sometimes.
Yeah.
But it's, I think that is like when you, like you said, you mentioned it earlier, and obviously as a former banker and being in this business, I mean, it's credit, character, and what's the third C? In collateral, right?
Yeah.
So, it's a character thing, and that's hard to always ascertain. And certainly at the end of the day, it's a business. I mean, you guys wake up in the morning, your job is to, bring in, potential deals and underwrite them and do them. That's how you feed your family and the people that work for you. And, if you say no to every deal, then, you're not in business. And I think, too, I'm not sure if it hit you guys as much, but, we've got a lot of other private lender clients. It's just a lot of times when everyone gets in the business, it ends up forcing down the rates too, right? I mean, even to put money out, because at the end of the day, money is just fungible. And if, like you said, like that particular guy who ends up, kind of creating this domino effect, he's going across the street to your competitor and saying, hey, and they're saying, well, we'll borrow you money at 8 or 9 or, whatever it is, and undercut you. So, I mean, how have you guys dealt with that, that dynamic over time as maybe the rate compression kicks in? And I mean, if at all, I'm not sure if you have, but.
Well, as you probably remember, when we first got started, we were charging 15% interest and 4 points on our loans.
Yeah.
And that was a lot. And then, over time, as more people got into this space because of the yields were so great, you have to start coming down and being a little bit more competitive, as it were. But that wasn't the only thing. You had a lot of institutional investment getting into this space. And they're great at raising money, but they're not great at understanding private loans. Again, they're either in LA or New York, and you have to underwrite in a box, and as long as your borrower fits in that box, it works out well. The problem is private loans are not in a box. Every private loan should stand on its own. So again, if you're in a position to be in that box, that's great. You can get much lower rates. I didn't really complain too much about that because a lot of your institutional investors were just as happy buying loans from people with feet on the ground as they were trying to originate them themselves. So we leveraged them in order to get extra capital to lend with. And then we would arbitrage the difference in what they wanted and what we were charging. And at the same time, we were lowering our rates. So we were actually benefiting the borrowers by having lower rates and fees, but we were making it up on what we would make from selling them to the institutional investors. So
yeah,
I was quite happy with it.
Yeah, exactly. And have you seen that sort of secondary market or the liquidity? Is that sort of slowed down a bit of late, or
quite a bit since COVID? Wall Street to me is like a herd of sheep. As soon as one of them hears a noise, they all run another direction.
Yeah, no, there's some truth to that. Yeah, exactly.
And it's cyclical. It happened in 07, 08 when things aren't great in the real estate business. They just put up their hands and go somewhere else. And the benefit of having private capital from individual accredited investors is that you don't have to depend on the institutional funds to run your business. It's nice to have them when things are good, but if you depend on them, then you're kind of a one trick pony. And if they decide they don't have an appetite for it any longer, what do you do? So we've been fortunate enough to keep a nice mix. We still have our private capital. We need more money. We can either sell off blocks of loans to those folks and recapitalize when we need to, at the same time still get a good return for our investors.
Yeah. So I know you and Wendy are both, have pretty strong networks and do quite a bit of, going to conferences, and you're involved in mastermind groups and all those things. So I'm just curious for you, I mean, what's sort of the biggest, implosion that you've witnessed or seen over the years, or just, sort of, in terms of, people take it in the shorts and kind of getting their ass handed to them, so to speak. Got any good stories for stuff that you've seen, that the cautionary tales?
Well, I have seen individuals that are wanting to take their IRA money and become their own lender with not enough understanding of the total bit. There's a lot of moving parts when you're a private lender, and people say, well, I can make this a lot more money if I do it myself. Number one, it becomes a secondary job.
Yeah.
And then number two, they don't ask the right questions, or they, let's say, overtrust someone. If you do your first loan with somebody, everything works great. Second loan with somebody, they tend to want to ask for a little bit more. And then the third and fourth loans, they're not paying you like they should. And you end up, this is what I see in private lenders doing it on their own, not people that are doing it for a living because they know better. Yeah. They'll front them more money than they should. And then they'll end up spending a lot more money than is available in the property if they end up having to take it back. That money has been spent and you don't know where it's gone. They may have used it for your payments. You don't know. Yeah. My biggest mistake is watching people with not enough experience try and do it on their own. There's nothing wrong with learning and doing it. Just be careful and have good mentors to help you along.
Yeah. Yeah. So the DIY sort of mindset of just, it goes both ways, right? It's like, to flip your first property or to be the lender on your first loan, it's generally going to involve some pain in the financial realm, is kind of what you're getting at.
Yeah. Well, that's how you learn.
Yeah.
But true wisdom comes from learning from other people's mistakes, not your own.
Yeah. Yeah. Most definitely. Yeah. Well, very good. Yeah. I mean, I think it's, it's interesting. Always comes back to that, right? It's just that, to me, it's that trust thing, and I'm fond of saying that in this business, trust is the transaction, right? And I do think that us as human beings are generally wired to sort of, it's by default we trust, right? Until something occurs that proves otherwise, right? Like that. I mean, and I think that, for me, that's how I approach people. I'm like, well, I just met you. I don't know you. Would I leave my kids with you? Probably not. Would I invest money with you? Probably not right away. But on the surface level, I'm just going to assume you're trustworthy until you do something that shows me otherwise. right? But that innate human sort of nature that we have of just being more harmonious and trusting isn't really the best way to go about making investments, right? And really in anything for that matter, right? Because, I think, and I'm not a proponent of us all suddenly becoming just more skeptical, because that kind of takes joy from you, and, who wants to do that? But I do think that, it's as you approach, any of these things, it's sort of like, okay, well, surface level, I'm going to trust what you're going to say, but there's the whole trust but verify, right? I'm going to, let's dig into it. At the end of the day, you are now asking me to make an investment, right? You're asking me to finance your project. You're asking me to do whatever. So, I need to set aside the fact that, hey, you're a charismatic, gregarious person or whatever the case may be. And, I like you and you're fun to hang out with, from the fact that we're now about to consummate a transaction, that's on a different level, and to me, then it's that implicit trust. It's I've done enough homework now to where I know what risks I'm taking. I know what can go wrong. Like you said, and I think you've often said that, right, is that it's just being aware of what's in your control and what's not in your control. Like you lending on a certain project is in your control to decide to advance that money. If that guy had 5 projects in the pipeline that, you weren't privy to, there'd be no way to know that. And, he's probably not going to share that information with you. Right. And so it's like, you have to, that's the whole thing, is that trying to navigate that process requires you to be, in tune with what's going on and know, like you said, it came down to the private lenders trying to do it on their own. They don't know what they don't know, and they're not asking the right questions. They're not going through, they don't have the pre-fight checklist that they're going through to make that decision. And they're more than likely going to overlook something, and that thing, increases the risk, and you're more than likely not being compensated for that risk.
Yep. And, at the same time, that goes for the borrower as well. There are market forces that you have zero control over. I mean, who would have thought that the COVID thing would come up?
Yeah.
You have no idea. You have the rug pulled out from under you when everything else is going great. Who sets up for that? Now, if you're a conservative person to begin with when it comes to money, you're always going to have a little set aside, and you're not going to be over leveraged. That was one of the things in 2008 that a lot of people learned. Of course, there's been a lot of people who have grown up since 2008 that never were a part of that.
Yeah. Yeah.
And that's typically your fix and flip person now, never really lived through 2007 and 2008. All they have seen, again, is values going up. They don't understand that values can come down.
Yeah.
But, one of the beauties of specifically residential real estate, because there's also a counter to that with some commercial properties right now during the COVID. Yeah. But with residential real estate, that the house doesn't care what it's worth. I like to compare residential real estate to like the gold salesman, where he was saying that gold has never been worth zero. But you know what? You can't rent your gold out, right? So residential real estate is like a hedge against itself. Yeah. When values are going up, you can sell it for a profit. If values are going down, you can turn it into a rental and get dividends from it. Again, it doesn't matter at that point what the house is worth, as long as you're getting a good cash flow from it.
That's right. So, and that's, like you said, that's the leverage play, right? Is that unlevered single family is not a bad play, right? I mean,
yeah, or a very low leverage.
Or low leverage, right? Yeah.
Right.
You can, but yeah, I mean, that's just it. Is that, like you said, it doesn't matter what it's worth, because at the end of the day, we all know that people need a place to live and put a roof over their head, and you can live to fight another day. Yeah, I mean, I agree with you. I mean, that's the beauty of single family, is its liquidity. I mean, and its versatility. Now,
from a fund management side of things, it's a lot of work, because it's a lot of small units, and there are fund managers that are dealing with much bigger numbers, and it's a lot less headaches because you're dealing with fewer units but much bigger numbers. The downside to that, again, is one of them messes up and it really affects the total.
Yeah.
So you have a lot more diversity, but it really can be kind of a headache for the manager when you're dealing with it.
It is, yeah. And I'm glad you brought that up. I mean, I think that's another good point is that, a lot of people, when they get into this realm, they're like, well, they hear about funds or whatever, and they're usually sort of referring to, some traditional private equity fund or, hedge fund or something, right? Where, it's 2% management fee and 20% of the, upside. The way I look at it is like, man, earning 2% on what often is like, could be in the private equity fund sense, $500 million or something, is pretty good compensation. So then when people sort of apply that same sort of 2 and 20 to some other strategy, like you're referring to, which I'd call more of a, micro strategies, just to set it in context, like a $20 million open-ended debt fund, like what you guys run or something. I mean, 2% on 20 million is a lot different animal than 2% on $500 million, where they probably only have, I don't know, maybe 10 positions, 10 companies that they have ownership stake in. Right. And so it's, that's where sometimes the math works against you. It's like the percentage is, I love percentages. They're great. They often can hold things sort of, relative and, but when you run it and say 2% times 20 million bucks, it's not that big of a number. 2% on, on $500 million is a really big number. It's kind of like the realtors, Wendy, probably be upset with me here, but that's like when they're selling houses. I mean, that's the whole thing. Where's the incentive? It's on a percentage. I'm getting 3%. Like the difference between 3% on $500,000 versus, $450,000 is, it's not that big of a deal. Right. So there's that, the alignment's not quite there. But those
the double wide on a half an acre is not paying you a lot.
Yeah, exactly. It's not the greatest thing. And if you got a bunch of those, it's called a pain in the ass. Right. So I think it's in all these things, right? It's trying to get people to just use this up here and think it through, right? Like that's what it always comes down to is like, hey, it's okay to trust people, but ultimately if you're going to decide to part with your hard-earned money, you really got to start thinking through, all of the different things that could go wrong and asking the right questions and just like you said, I mean, like even for you, like in Charlotte, you're going, you weren't comfortable with the fact that, these homes on the whatever part of town were suddenly being worth money. Cause in your mind, you're going, I just don't think they're worth it. Right. I mean, that's what it comes down to. You're just saying that, like I said, that value's not there. Cause you're thinking like this, you're thinking, well, if I did own that home and I had to rent it out, that's the problem with these, these higher dollar homes is like, it's hard to get that kind of rent out of them. Right. So it's just not that great. And then the market for those who can afford those homes is less, the financing's less, right? And that's not as liquid. And so, those are the things, but sometimes that's the glitzy stuff, right? People look at the photos of the homes that, people are buying, or fix and flipping, it's not that sexy, right? Especially the before photo, right? Yeah. Where's that $500,000, 750 million or some other development project, the photos and the renderings look amazing and people, they fall into that stuff. And it's like, man, that development project, there's a ton of risk on that deal. Yeah. You'll own a part of some really nice looking building, but once again, does that fit for what you're trying to do? And it always comes back to that. It's not what the Joneses are doing. It's not what other people are doing. It's like, what are you trying to do? Right. It doesn't make sense to you. Do you understand it? Which is the point of this podcast. I'm trying to help people like you shouldn't go into these things and just invest into stuff. And you mentioned it earlier before we hit record here, right? It's like, you want to be dealing with people that understand what it is that you're doing, not just people that are just blindly giving you money, right? Like that doesn't work because invariably their own ignorance will end up causing you a problem later on when they don't understand something that's taking place.
Absolutely. We had that discussion earlier that funds are all different. They invest in different things. And if you're an investor, it's your duty to understand what it is that the fund is investing in and how it's being invested and how the management gets paid. And oh, by the way, you should be able to get recommendations or referrals from other people that are in that fund. I know I keep a list of about 50 different investors that they can chat with, either text or phone or email, about how their experiences have been with us. At the same time, if you can't explain the investment to your spouse, you shouldn't be doing it.
Yeah, that's exactly right. That's simple.
Yeah, it just comes down to if it's too complicated for you, it's probably not something that you want to get involved in.
Yeah, that's a good rule of thumb, and you won't go wrong doing that. So, cool.
Yeah, and lastly, by the way, thank you for putting together the vetting process for a lot of different funds. What you're doing is a great service to investors, and it gives the fund operators that understand that they need to have an open book, the ability to be out there and show all their cards. It's look, when you're doing private placement funds, the manager doesn't have to show you squat. It's the ones that are showing you everything that you want to do business with.
Yeah.
It's difficult. You need to really be with somebody that you have several sets of eyes looking at the books and the numbers.
Yeah, I agree. And I appreciate that, Bill. And it is, for me, this is, it's become sort of a mission, right? And it's become personal. And, and only as much because I just believe that, being transparent, is just how things should be. I mean, it's like from the sponsor standpoint, right? Like they said, if you got nothing to hide, there's no reason to not show it, right? And then that's freeing too. And then on the flip side, for the prospective investor and the investor, I mean, that's the thing that it makes it operate more efficiently. My ability, once again, going back to the trust thing, if you're being transparent and you're willing to, have it out there, and you do have an independent set of eyes that's looking at it, making sure that everything's being done as I would expect, then, it's because you can sleep better at night, right? So when you make the investment, because you've probably heard this a lot too, is just many investors, it's like they literally make these investments and they're just terrified the entire time that, that one day they're going to get a call or an email or a letter in the mail that says that they were involved in some Ponzi scheme or something.
Right.
To me, the fact that when I go and speak candidly with so many passive investors, and that comes up nearly every single conversation where they're like, well, if I'm being honest with you, I'm actually always terrified that I'm involved in some Ponzi scheme. And I'm just going, that's really odd. Like that would be where you're at. Like, and, but they're like, well, I trust these guys, but you just never know, and it's like, well, it's true that you do never know until you can know. And I just do hope, ultimately that's what it's all about, is just to make the market operate more efficiently. One, if we can just have more investors who understand, like you said, they actually understand these investment options and how they solve problems in their own portfolio, then more people will participate. And if you remove some of the friction of what stops people from making investments and you eliminate it, then more capital is flowing into the space. And then, you still have the benefit of it will never be completely efficient. Like, the public markets more or less operate, which is why you can't get any alpha. Really, it's very difficult to get alpha in the public markets because it operates so efficiently now that you can't get any value out of it, right? Which is tough.
You see, at the same time, we can't operate in those markets because the stuff that we're doing is too small for them anyway.
Yeah.
And that's why the value is there, because we're dealing in an area that institutional investors don't have time for. Yeah. There's more work involved and there's a lot easier things to do. And that's why they're doing it. I don't want to say we're operating on the periphery, but we are.
Yeah.
We're operating in markets that are too small for those large funds to waste their time with, but there's still value in there.
Well, there is. And that's what I say. I think that's where you can get up that's where you can, as the end user passive investor, can scrape the premium. right? So that's what I mean. If you can mitigate a bunch of this other risk, like, hey, are these guys crooks and felons, and are they, misappropriating my funds and whatever? I mean, because once again, without the transparency, then it has to be baked in. I mean, in my opinion, whether people are doing this consciously or not, you have to bake those things in, and it becomes a risk premium. So you're saying, I'm willing to invest in this opaque investment where I don't know anything, but I expect to receive a return in exchange for the risk I'm taking. Whereas if we can eliminate that, it makes it more competitive, but you still have the inefficiency premium, right? Because of the fragmentation and the fact that, you can't have a ton of capital pouring into it. That's the beauty of sort of that middle market space, or the space that, you operate in and most of our clients operate in, is that's the beauty of it. And to your point, the institutions, it's really hard to get into it. They'd love to, but it's just, they can't, there's too many moving parts. It's just too difficult to allocate capital when they need to do it. So the benefit goes to the high net worth investor. So once again, if you're not accredited, then you're kind of stuck with, the public markets. If you're accredited, then the benefit is you can participate in these markets. And sure, maybe you can't get into that, killer private equity fund that's got $1 million minimum or something, boo-hoo, whatever. I mean, like, it is what it is, right? But in the real estate side, there are plenty of options that can satisfy that portion of your portfolio, whatever it is that you're trying to solve for. In this case, like your guys' investment, it's an income thing. It's hard to find income producing or yield generating, investments. I mean, the bond market is trash, not to mention the volatility. And then even the dividend producing stocks. I mean, the dividend's not much, but you still have the volatility of the stock price.
Sure.
Right. And so it's just, when you really narrow it down, it's really hard to find yield, period. And stop. Like, it's just difficult to find. But once again, the way I look at it is that many people who should be participating or have more of an allocation aren't, because they don't understand. That's the fear factor, right? And so, it's for me, it's like narrowing it all down to figure out, like, how do we sort of find solutions to some of those things to make it easier to participate? So,
well, I have found in the past that most people that gravitate towards real estate is because most people have a home. Most people have a mortgage, and those things are a little bit easier for them to understand. If they understand the basics, they should understand most of the investments. It's when you get into a little bit more complicated development stuff, they need a little bit more education. I'm not saying there's anything wrong with those. They just need to be educated a little bit more on those. Most the risks that are involved.
Yeah, you got it. Because it touches on so many other risk, so many other points of risk that are complicated and challenging. And once again, I mean, if you've got the cash laying around to put money into that, or like you said, if that's what you're trying to do, is you've got, I mean, there's a place for it in your portfolio, but it definitely, in order to get your mind wrapped around all the risks that you are taking and getting comfortable with those and ensuring that, the return you get is sufficient. Because I mean, I see it all the time where you've got projects coming in where, once again, developers like to build things. That's part of the problem. They just, it's good for them because they have a passion for building things, and they want to, they want to do it, but at times they're a little out of touch with sort of like, well, does the project actually, is it going to generate a return that, meets sort of the risks that are involved with this project, right? Because to me, I talk to sponsors all day long, and many of them are developers. And I'm like, listen, man, as far as I'm concerned, and I'm not looking to invest or anything, but I'm telling you, if you got a development project from the ground up, put it in front of me, I'm expecting that I'm going to net 30 IRR, right? And I would expect, like, I hope I can triple my money, right? I mean, and so like, if you haven't underwritten it to that, then, I'm just saying, like, it makes sense. Cause to me, I'm just going like, so many things could go wrong.
Yeah.
And so if I'm going to put money out there, then I want to make damn sure that I'm, that I'm being compensated for those, those things that could go wrong.
2, 3, 5, 7 years. There's a few things that can happen in that time frame.
Lots of things. You touch on everything. So, yeah.
And here's a good indicator with builders that I've found over the years. They'll get into an area where there is a need, and they will start developing, and they will continue to develop until the bank says, nah, we're we're a little bit too much. And what they end up doing is they oversaturate the market.
Yeah.
And then the investment for everyone that's been in that market starts going down because now they've oversaturated. Then everybody stops. And then a few years later, there's a need again.
Yeah.
So it's a terrible cycle, and you don't want to be on the back end of that cycle.
Yeah, it's definitely, it's boom or bust. And, once again, obviously we need developers who have vision to do things. Like that's what makes ultimately the world go around. So but once again, that's why to me, it's like, it's all fine. Like none of this is bad. That's why talking about risk isn't bad. It's just, when you've got to make sure that you understand, what you're doing and why you're doing it and what your expectation should be in return. And it's a great way to build wealth. If you know what you're doing and you know how to evaluate projects and developers and those sorts of things, you can make a truckload of money doing it. Right. Yep. And you should make a truckload of money doing it because the risk you're taking is pretty great, but it doesn't make it bad. It just means, now in a portfolio, you just want to make sure that it's not your entire portfolio. I mean, you don't want to put all your eggs in one basket. So there's nothing wrong with using that. Maybe you can't get into that, that PE fund that's going to crush it or whatever. And, but that is a good alternative for a true growth investment in your portfolio. To allocate some of that to that, if that makes sense for you. Once again, it's all contextual. Right.
And again, that basket is going to change over time.
Yeah.
If you're young, that basket can have a lot more risk because you have more time. At the same time, as you get older and you're going to need that money to live off of, then the basket needs to change.
It does. Yeah, it definitely does. And as I get older, you experience the aging process. It's like, you can't just go run around and do all this stuff. You move a little bit slower.
You still look like you're 17.
I do. I look young, but man, I don't feel young. It's like, it gets you every year that goes by. It's like you start to slow down. So yeah, definitely it's the portfolio needs to change over time. And, So anyway, it's been great, Dylan. Thanks for catching up. And I know you've got
pleasure
stuff to do, and appreciate you jumping on. I know you're on the back end of pneumonia and stuff like that. So you're a trooper, and I appreciate it.
Thank you. I really appreciate you having me on, and it was a pleasure catching up with you again.
All right, man. You take care, and we'll be in touch.